Canada has an abundance of natural resources and massive production avenues, yet its economy is faltering, and it is faltering fast. Historically, we've seen that countries rich in energy products hit hard when their economies go into a slump. Countries like Argentina and South Africa used their natural resources to fuel growth until their governments made a series of bad decisions and overinvested in one economic sector. Is Canada driving itself to a similar fate? It seems like it. In this video, we are breaking down Achilles' heel of the Canadian economy, the Bank of Canada's recent decision to hike the interest rates and its impact on the housing sector, and Canada's long-drawn battle with a stagnant GDP. But before that, give this video a big thumbs up and subscribe to our channel for more informative content like this. All things considered, Canada's economic trajectory is paradoxical at best. For a country that has relied on its natural resources to maintain economic goals, it is slumping a lot when it comes to wealth generation. A recent trend in the country suggests a broader shift to green energy that is both expensive and poses major development costs. The growing hostility towards burning fossil fuels aside, the country hasn't exactly given up on its natural resources to keep up with the economies of scale. At the same, it's not a hidden secret that the Canadian federal government has redirected a colossal amount of public money to decarbonize its energy sector. The most obvious problem here is that the government hasn't been able to curb the emissions to stay true to its climate action goals. To put it simply, Canada is putting a major chunk of their money into a sector that is neither productive nor lucrative. And that's a problem. What really doesn't meet the eye here is how the country is treating its corporations and large-scale businesses. Apart from its focus on green energy transitions, the Government of Canada is overly compelling corporations to become benevolent organizations. Increasing taxation, prioritization of workers over shareholders, ever-changing economic philosophy, and whatnot. The Government of Canada doesn't seem to help itself when it comes to honing productivity in its public and private sectors, despite heavy taxation. The country's low productivity is its Achilles heel, and it doesn't seem to take notice. In developed economies, wealth creation is closely related to productivity and the overall efficiency of labor. Canada is severely falling behind in foreign investments, and it's pretty simple, right? Any multinational corporation would look at Canada's productivity profile and the overall enhancement of technological infrastructure only to invest somewhere else. Heavy taxation, faltering green policies, and low productivity are the unholy trinity of Canada's economic slump. Numbers tell us a similar story too. Ever since 2015, the country's GDP per capita has increased at a very gradual rate as compared to its counterparts like Australia, New Zealand, the United States, and the UK. As it stands today, Canada isn't creating wealth while investing billions into its public sector. Not to mention, the country's one of the biggest sources of revenue is taxation, and on the outlook, it seems like the government isn't investing the money into its infrastructure at all. We all know that it's not true. The only problem is that the country's priorities are misplaced. Despite generous spending and hefty taxation, the interest rates in Canada are soaring. And on top of that, it remains fixated to overspend on a less productive sector of its already faltering economy, housing. And we might have just cooked a recipe for a disaster here. Finding the video interesting so far? Give us a like and subscribe to our channel. Capital investments play a vital role in any economy. They're like the fuel that powers the engine of growth and prosperity. Unfortunately, Canada seems to be running a bit low on that fuel, and it's putting a halt to its economic progress. The country's relatively higher interest rates and borrowing costs can make it less attractive for businesses to invest. In June 2023, the Bank of Canada hit a 22-year high with its interest rate, making it a whopping figure of 4.75%. Sure, The government's biggest priority was to deal with the inflation crisis that has bugged the Canadian economy consistently now. In the Bank of Canada's own words, monetary policy was not sufficiently restrictive to bring supply and demand back into balance and return inflation sustainably to the 2% target. Keeping this in mind, the bank is also expected to hike the borrowing costs exponentially in the following months of 2023. And that could hurt Canada's prospects with investment and its beloved housing sector. Here's why. There's a case of risk aversion in Canada. Investors can be a bit hesitant to take bold risks and pour their capital into new ventures. High interest rates are a living testament of Canada's capital investment shortfall, and experts fear it's only the beginning. And it's quite simple. The economy isn't getting the boost it needs to thrive and expand. The lack of capital investments also hampers innovation and productivity growth. Without the financial resources to fuel research and development, businesses can't unleash their full potential. Overall, the biggest hit here occurs to Canada's housing sector that is going to crumble under high interest rates and cumulative slump in demand. In Canada, this housing frenzy has reached such heights that it's causing folks to fret more about buying a house than investing their hard-earned money in the market. You see, property prices have been soaring, making the thought of homeownership both exciting and anxiety-inducing. The dream of having a place to call your own is deeply ingrained in Canadian culture, but with prices shooting up like fireworks on Canada Day, many find themselves caught in a whirlwind of doubt. This obsession with homeownership also stems from a cultural mindset. Canadians have traditionally seen real estate as a safe and reliable investment. It's like a security blanket, providing a sense of stability in an uncertain world. But the increasing cost of housing in the country is increasingly leaving people without a roof. Just in 2022, Canada saw a major boom in its population as the new statistic met a record high of 40 million people. Yet, the population growth also happened in profound, turbulent times for the Canadian economy. The youth is highly economically vulnerable. Living costs are all-time high. Inflation is uncontrollable. And, well, housing is unaffordable as well. With the high interest rates, the demand for housing is bound to plummet further, and that becomes a huge problem for Canada as it has disproportionately invested in real estate as opposed to other high-productive sectors, such as tech. Let's just say that the Canadian government needs to get its priorities straight, because pick any economic briefing on the country and you'd know that overall, its economy is slowing down altogether. While its recovery from the pandemic slump was steady, it has suffered immensely due to a strategic reshuffling of its labor. There are a few reasons why Canada's GDP isn't growing as fast as we'd like. One big reason is that Canada relies heavily on its natural resources without enhancing its export capacity. In the aftermath of the war in Ukraine, many major energy importers in Europe had a fallout with Russia. Essentially, the entire old continent was fighting a major energy crisis as it looked for alternative markets to fill in the gap. That was Canada's golden opportunity to make a strategic use of its natural resources and curb the inflation costs that the war had brought in. However, its weak infrastructure allowed major markets like the US to step in while Canada only watched. And Ottawa seems to lose a lot more than oil markets to Washington. Another reason for the country's slow GDP growth is its smaller market size and limited economies of scale. Unlike big players like the US or China, Canada's domestic market isn't as big. This can make it tougher for businesses to grow to a size that can really get the economy moving past its slump. To make it matters worse, the country also has a bad precedent when it comes to holding down its labor supply. Canada's very own brain drain sees 45,000 of its citizens crossing the border annually, contributing to a potential shortage of skilled labor in the Great White North and bolstering America's workforce. Each year, like migrating geese, a significant number of Canadians pack their bags and head for the land of opportunity. But what does this mean for Canada? Well, this brain drain can lead to a loss of valuable human capital. Skilled workers, professionals, and bright minds find themselves lured by the siren song of higher wages and greater career opportunities. It's like a talent show, and America seems to have a bigger stage and brighter lights. As these skilled individuals cross the border, Canada faces challenges in maintaining a robust labor force, especially after offering far more affordable education than the US. This particular loss of talent creates a gap in one key sector, Canada's information technology arena. It's not hard to see why the US takes a robust step in garnering tech experts and skilled workers. There's a reason why Silicon Valley is booming with tech startups that are changing the outlook of the US economy. Gone are the days when developed economies would make dimes from resource optimization. In this age and time, tech is making more and more avenues for wealth creation. And we can't also deny that the US is a lucrative market for tech startups that leaves Canada with a weak incentivization structure to appease its IT sector. After all, the US has a great deal of brand recognition and high-paying jobs. What's not to like? And that's all for today. We will be back with more insightful videos soon, so stay tuned.